Hello everyone, welcome to my YouTube channel AquaAid Academy and to this comprehensive guide on bank reconciliation statements. In this video, we'll demystify the process of reconciling your bank accounts, which is essential for individuals and businesses to ensure their financial records are accurate and up to date. By the end of this video, we'll have a thorough understanding of how to prepare a bank reconciliation statement with the latest approaches. Please subscribe, like, share, and don't forget to hit the bell icon, my channel. Now come to the point. What is a bank reconciliation statement? Before we dive into the nitty-gritty of preparing a bank reconciliation statement, let's understand what it is. A bank reconciliation statement is a financial document that helps you compare your financial records with those of your bank, ensuring they match. Discrepancies between the two can arise due to timing differences or errors, and the statement helps identify and resolve them. Now come to the point. Why is it important? Bank reconciliation statements are crucial because they ensure the accuracy of your financial records. They can help you spot errors, fraud, or unauthorized transactions. Plus, it's a critical tool for managing cash flow and making informed financial decisions. As I told, the word cash flow, until and unless you don't know how much money you have in your bank, you can't issue check to your suppliers or creditors. So that's why it is important to manage your cash flow. To maintain the cash flow, you have to be you have to prepare the bank reconciliation statement to know what is the exact position of your bank balance on a particular period or on a particular date. Now, when we prepare bank reconciliation statement, there are few steps to be followed and which are very crucial and important. The step one is gather necessary documents. Now, what are the documents these are? First is your bank statement, second is your general ledger, and if any additional documents are related to bank transactions. The second step is compare deposits. Whatever deposits you have made during a particular period, whether these are matching with your bank statement or not, you have to identify these. Their nature, such as outstanding deposits. Now, step 3, compare withdrawals. Whatever checks you have issued or your company has issued, that should be reflected in your bank statement. If not, then differences and categorize them like outstanding checks. Suppose you have issued a check to a supplier, but it has not been presented to your bank. Obviously, your bank balance will show high, and that will mislead you to check whether your bank balance is correct or not. And step 4 is address timing difference. This is very important. Time differences can occur due to processing delays, as I just explained that you have issued check, but it has not been presented, so there is a time gap. Okay, and it may happen to both deposits as well as withdrawals. And steps 5 is reconcile the statements. Combine the adjusted balances from 2, 3, and 4 to reconcile your bank statement with your records. The final figure should match. If it doesn't match, then you have to investigate further. Now take an example. Here you can see I have the bank statement as well as I have company's records. Now, when you will prepare any bank's reconciliation statement, there are two books up there. One is maintained by bank and one is maintained by your company. And you have to take two of them as base. So here I have taken balance as per bank statement. You can see there. And my balance is $4,000, right? Now go through four examples only. The first one, check deposited but not credited in bank. That means your check, you have received a check and deposited to your bank account, but it has not been credited into your bank account. That means what is the bank balance you have, that the check amount should be added to this balance because this has been deposited but not has yet been reflected into your bank. Mind it, when bank is credited, your balance is increased, and when bank is debited, your balance is decreased, right? So that is why this deposit in transit will be added back to your balance, right? Now, next example, check issued but not debited by bank. That means you have issued a check, but this check has not been presented to the bank or it has not been cleared into your bank account. Obviously, your balance will show high, but the actual fact is not like that. The balance should be decreased since you have issued a check to some party. Okay, so that's why it has been deducted from your balance and the check amount is $300. So after adjusting these two items, this is called your adjusted bank balance as per bank. Okay. Now which comes to 4,200. Now there are two other entries. These two, the first two examples, you know, rather company knows what they have done. But when interest credited by bank, you don't know until and unless you get the bank statement. So that means you have not recorded yet your interest for a particular period, right? So this has been credited by bank, but your company's book is showing that it has not been credited. So this interest should be added back to your balance. So interest earned will be added back to your balance. Similarly, there's the bank charges debited by bank. That means since bank is maintaining your bank account, so some charges are debited by bank from time to time, and this will reduce your balance. So that's why it has been deducted from your original balance, that is $20. So after adding as well as after deducting all the transaction, your final balance will be $4,330 and it is called adjusted balance as per company. So that's all from my end as bank reconciliation statement. Please, those does who haven't yet subscribed my channel, please subscribe my channel, hit the bell icon for my upcoming videos. Thank you very much.